Look at this 3D line graph. It illustrates exactly what investors are experiencing right now. Prices are violently swinging up and down, day after day. One day, your portfolio is flashing massive gains. The very next day, a sharp drop wipes them out, leaving you with total whiplash. Right now, companies are dumping their Q4 earnings reports into this environment. We're seeing profits, surprise losses, and deep disappointments, all acting as fresh fuel for these wild price swings. So when you log in and see this chaos, what exactly are you supposed to do? Do you panic? Do you wait? Do you buy? Or do you sell? Surviving an environment like this comes down to one specific skill. You have to learn how to block out the temporary, chaotic market noise and tune into the actual signals that drive long-term wealth. To find that signal, we first need to understand the noise. Market volatility simply means the rapid movement of stock prices in both directions. Currently, that movement is being forced by heavy macroeconomic stress. We are tracking widespread global economic uncertainty, shifting expectations on interest rates, and stubborn inflation. This web chart plots those global factors alongside our local and geopolitical stressors. You can see how the buying and selling activity of foreign institutional investors, combined with fluctuating crude oil prices, all press down on the market at the exact same time. When all these pressure points converge, the market becomes a coiled spring. In a highly reactive environment like this, even a completely standard corporate announcement can trigger a massive jump or drop. That brings us to Q4 earnings. This specific quarter acts like a magnifying glass for volatility because these results dictate the narrative for the entire fiscal year. Investors are pulling apart these reports looking for two specific things: validation of how the company performed over the last 12 months, and management's guidance on where the business is heading next. On the left, erratic price movements. On the right, stable pillars investors track: revenue growth, profit margins, and debt. Expectations change by sector. Banking is judged on loan growth, IT on global demand. Auto reacts to vehicle sales, while energy adjusts to commodity prices. Because expectations run so high during these announcements, even a strong company can see its stock price correct downwards. But a short-term price drop does not mean the underlying business quality has degraded. Watching a portfolio bleed red for days on end is stressful, and that emotional stress pushes investors to abandon logic in favor of impulsive reactions. The most common reaction is panic selling. Investors dump high-quality assets simply because the broader market is dipping, locking in losses that never needed to happen. Then comes the urge to act on social media rumors, followed by the futile attempt to perfectly time the market top or bottom, something nobody can do consistently. This line chart shows the trajectory of a systematic investment plan, or SIP. The red gap here highlights the most damaging mistake you can make: pausing your contributions during a market correction. By stopping, you permanently sever the chain of compound interest. By giving in to emotion and making these errors, an investor takes temporary market noise and turns it into permanent wealth destruction. So how do we filter out that noise and find the signal? It starts with a rational checklist. First, take a hard look at your current portfolio. Check to ensure your holdings still align with your original financial goals and your actual appetite for risk. Second, look past the daily price tag. Focus your attention entirely on the underlying business fundamentals, prioritizing consistency in earnings and focusing on realistic, long-term growth potential. Third, build a defense. Maintaining a diversified portfolio spread across different asset classes and sectors ensures that a hit to one specific industry doesn't sink your entire net worth. Finally, stay disciplined. This bar chart demonstrates how cost averaging works during a dip. As prices drop in this trough, your steady SIP contributions in blue automatically accumulate a higher volume of units. The dip actually creates the wealth-building opportunity. Proactive discipline and a strategic allocation of your assets act as the ultimate shield against market panic. This macro timeline plots the market index's history. When we zoom out, you see these short-term red corrections are completely dwarfed by the massive upward growth curve in blue. Markets perpetually move in cycles of dips, followed by inevitable recoveries. The takeaway is simple. Market volatility is strictly temporary. Financial discipline is permanent. Stop reacting to daily headlines and keep your focus locked on your long-term financial journey. If you found this breakdown helpful, like this video, share it with your fellow investors, and subscribe for more insights. And remember to consult financial experts when needed to stay informed and wisely invest.